The monthly paying dividend stock Realty Income is now trading at a multi-year low at around $46 per share. Now this is due to things like higher sustained interest rates, the fact that Realty Income keeps issuing more and more shares, and the most recent few acquisitions such as the Bellagio and now the Spirit Realty acquisition. In this video, we are going to analyze Realty Income where it sits as of right now and see if or if not this REIT is still a buying opportunity in my opinion. Because to be completely transparent, as of right now, I currently own over 2,600 shares of Realty Income, making it one of the largest assets across all of my portfolios. Now, if you hold Realty Income or have thought about it as of recently, you are definitely going to want to stick around. Now, just to go back for a second, Realty Income has had an excellent track record historically when it comes to generating shareholder value over time. And this is one of the biggest reasons on why I own so much of this REIT. But over the last year or so, Realty Income, along other REITs pretty much across the board, have not done all that great. Realty Income has also always been a REIT that puts a lot of focus on growing the business and expanding and continuing to play on the offense. Now, this has happened by doing things like acquiring assets and, of course, by acquiring entire asset portfolio companies. And while clearly some investors are not all that fond of Realty Income's continuous aggressive offensive plays, I personally think that long term this is going to play out for the benefit for Realty Income shareholders long term. Now, year to date, Realty Income is down around 23.2%, which is insane. And over the last year time frame, 25.77%. Now, what's even maybe crazier is that since Realty Income's most recent high, the drawdown that we're seeing currently is now just as bad, if not worse, as the drawdown Realty Income investors saw back in 2008 and, of course, during March of 2020. It's in that same range, which is partially why, in my opinion, without a doubt, Realty Income is definitely a buying opportunity at these levels. Now, also super bullish in my opinion, Simply Safe Dividends did reaffirm as of October 30th, 2023, that Realty Income still has a safe dividend, an 80 on the safety score, with a forward starting dividend yield of around 6.65%, which is bananas. They said in their report, Realty Income announced it will acquire retail REIT, Piers Spirit Realty Capital, or SRC, in an all-stock transaction valued at $9.3 billion, or roughly 17% of Realty Income's enterprise value. The deal is expected to close next year, first quarter, and is subject to shareholder approval from Spirit. They also said the deal is expected to be over 2.5% accretive to Realty Income's AFFO per share, a REIT's equivalent to earnings. Within the first year, the firm's payout ratio should remain below 80%, which is pretty good. Now, additionally, management has stated the deal will not affect the REIT's current dividend policy. As such, we are reaffirming Realty Income's safe dividend safety score. Furthermore, while Realty Income will assume Spirit's outstanding debt, there will be little change to the REIT's overall debt profile, which is also bullish. With less than 15% of the combined firm's fixed rate dates maturing in the next 3 years. So in a high interest rate environment, it's sort of a race against the clock to hope that most of the debt is going to mature long into the future, because if any debt needs to be refinanced anytime soon, a lot of these REITs could find themselves in some trouble. It also says, in addition to the modest AFFO per share growth the merger provides, the decision to combine seems to be driven by the desire to increase scale, which Realty Income has been doing pretty significantly. By issuing more shares and playing on the offense, Realty Income is becoming a real-life monopoly board, owning almost everything across the board, it seems. And this is, of course, going to possibly lead to having more favorable financing options down the road, because scale can be everything, and deeper relationships with overlapping tenants. The two REITs have very similar portfolios with solid occupancy rates of around 99% and many overlapping tenant relationships. So it is pretty interesting that if you look at Realty Income in the orange and Spirit contribution in the blue or the black, you can see that they have a lot of the same tenants, which is probably more the reason why Realty Income thought it was going to be a great option to buy up the company and to combine the two. I also think it might be interesting and helpful for us Realty Income investors to see exactly which are the top tenants when it comes to Spirit Realty. And I want you guys to comment down below which of these tenants you like and which ones you hate, which we see Shopko at almost 30%. So Shopko is the majority of this portfolio, which is pretty interesting. Now, just off of first glance, I'm not necessarily super bullish on that because I'm not the biggest fan of Shopko, and they do seem like more or less a store of the past. But then we got 84 Lumber at 6.6%. We got AMC at 2.9, Universal Pool at 2.3, Camelback Resort at 2.1. Then we have Walgreens at 3.8, Lifetime Fitness at 4.2, Most of these are pretty creditworthy big stores that I honestly wouldn't really hate having in my portfolio for the most part. Now, another important aspect is, of course, the industries and general merchandise, because the Shopko, of course, is the majority of the overall portfolio at around 30%. Then we have convenience stores around 10%, and then distribution at around 11%. So around 50% of the portfolio is general merchandise, convenience stores, and distribution, which honestly I'm okay with. The only industry that I'm not really a fan of right now is office buildings. This merger also keeps Realty Income's focus on convenience, essential service, and low cost oriented tenants with recession resilient qualities better suited to combat the rise of internet retailers. The combined firm's exposure will remain a similar tilt toward the 80% of rent and industrials around 15% sectors. And we've talked about ad nauseum at this point Realty Income's tenants and the fact that most of their tenants are in what I like to call recession-proof industries, which is going to really be tested most likely over the next year or so. Simply Safe lastly said this strategy has helped Realty Income pay dividends without interruption for over 50 years, while becoming the fourth largest REIT in the S&P 500 post-acquisition. They then said overall, while higher interest rates, see our most recent note here, and the souring outlook for the American consumer could slow growth in the years ahead, Realty Income looks to be well positioned to endure these worsening economic conditions while continuing its low single-digit dividend growth trend. We'll look to monitor closely though moving forward. So where do Realty Income investors go from here? The stock is currently yielding around 6.65%, still has an 80 on the safety score, which again, always take everything with a grain of salt. If you think Realty Income's dividend might not be as safe or more safe, by all means, go with whatever you think. But with this most recent acquisition and the growth that Realty Income has been showing over the last few years, Realty Income is truly becoming somewhat of a mega REIT, and still with a relatively low beta, in my opinion is still a sleep well at night stock for long-term investors willing to weather the storm like myself. Now, some of you might be curious or maybe even concerned about my over 2,600 shares of Realty Income that I currently own across multiple portfolios. My current average cost across the board is probably somewhere around $55 per share. It's hard to say because I've been selling covered calls pretty much all the way down since the top of Realty Income's trading. But that being said, as far as any single stock goes, Realty Income, in my opinion, for my risk tolerance and for what I personally look for as a long-term dividend growth style, income-focused investor, is still a great option to keep adding here and there, and I most likely will do so long into the future. And this is whether Realty Income trades down below $45 per share, or maybe makes its way back up to $55 per share sometime soon here. But with all these recent acquisitions such as the Bellagio and now Spirit Realty, along with the Wynn Resorts Encore Boston Harbor Casino and Luxury Resort, Realty Income is building out a massive portfolio that's still heavily diversified, although there still are some clients within Realty Income's portfolio that I'm not necessarily thrilled about. But now I want to hear from you guys down below. When it comes to the monthly paying dividend stock Realty Income, are you currently buying at these levels as of right now in the mid-40s? Or maybe a lot like other investors, are you running for the hills and trying to wait out the storm and sit on your hands quietly until you see what happens next? Comment down below. If you enjoyed this video, make sure to please drop a like on it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.